Well, greetings and salutations, test takers. This is Series 7 Guru coming to you from my off-grid studio, getting my kicks on Route 66 with another explication request. If you have an explication request, send it to explicationrequest@guruexamprep.com. We'll help you with any question for any FINRA or NASA exam. If it's a Kaplan question, it's a little easier. You can send me the QID and I can bring it up backstage. If you don't have a Kaplan Q Bank, I highly recommend it as a paid supplement. With my 15% discount code at checkout, you can get a Kaplan Q Bank, 3,600 questions, a performance tracker for an investment of $55.80. I think that's a great investment as a test taker. For that commercial, Kaplan allows me to give you a free look at Kaplan content like this. This is QID 1559383. You have a client who plans to liquidate some CDL stock to help pay for an upcoming family vacation in late August. When checking the account record, you find the following transactions. January 4th, 100 shares at 43. That's the cost basis. Cost basis is simply when you turn your money into the investment. It looks like we're going to do some sales proceeds here. We turn the stock back into money. All right, let's see. February 8th, 100 shares at 39. That's our cost basis there. May 11th, 200 shares at 48. So that's our cost basis per share there. Client needs about $4,000. So we're looking for 4,000, and CDL is currently trading for 44. So, we're going to sell a round lot that will give us somewhere close to approximately $4,000. From a tax standpoint, so that's the pivot, tax standpoint. You should probably recommend that the client, all right, well, let's see, sell 100 shares purchased on May 11th. So if we do that, we sell 100 shares there. The client gets to keep 4,400 and has a $400 realized loss that he can use to offset gains somewhere else. So that sounds pretty good. Let's look at our next one. Sell half the shares purchased on January 4th and half the shares on February 8th. Why would I do that? I mean, that makes no sense. But the three ways I can do this when I've been buying shares over several time frames is I can use share identification. I can use average cost, or the IRS can impose upon me first shares I bought or first shares I'm selling. But I don't think I want to do that from a tax standpoint because the stock's at 44, right? So that means my client is going to have a $100 gain there, or I shouldn't say 100, a point on 50 shares, and then 4 points on 50 shares. He's going to owe taxes on that. So the client isn't going to end up with as much money because he's going to be paying taxes. Remember, it's a tax standpoint. There's no tax. I'm not going to lose any of my money to taxes. B, some of the proceeds are going to be eaten up in taxes. So all the purchase stock sold on purchased on January 4th. Well, again, that would be a short-term game of 100. So the client would not really actually even receive 4,400 because $100 gain, some of that's going to the IRS. Sell shares purchased on February 8th. Again, the whole point of doing share identification, that's what we're going to use here, is we want to identify the shares we have the highest cost basis on, because even if that's a gain, it'll be lower than the ones I have a lower cost base, or in this case, I have a loss I can use elsewhere. So I'm going to have taxes on all the choices except A. And A, the client walks with 4,400 and a loss he can use to offset gains elsewhere in his portfolio later on. So in general, the answer here is A. In general, we want to use share identification because that gives us the most flexibility. And we want to identify the shares we have the highest cost basis on, because that would generate more proceeds to the investor, less proceeds, if any, to the U.S. Treasury. So the answer in the question is A. Remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard. And I will see you for the next explication request.